President Trump is in Japan for the second leg of his nearly week-long trip through Asia.
President Trump wrapped up the Japan leg of his Asian tour today, where he announced a trade deal after meeting with the country's new prime minister.
It finally happened. Japan has stopped behaving like America's quiet, obedient banker. For decades, Tokyo quietly absorbed U.S. government debt, helping to keep Washington's borrowing habit under control. Now, inside one of the world's most conservative financial systems, that role is being questioned in a very public way. This shift is bigger than a technical policy adjustment. It goes to the heart of how Japan sees its security, its money, and its relationship with the United States. For years, the pattern was almost mechanical. Japan earned huge trade surpluses, parked a big slice of that cash in U.S. Treasuries, and trusted the American state as the safest place on earth to store national wealth. That old logic is now under pressure. A combination of rising U.S. debt, tariff aggression, and financial weaponization has turned what used to be a safe anchor into what many in Tokyo now see as a potential liability. Three forces in particular have pushed Japan to rethink its role. First, the U.S. national debt has exploded to levels never seen in peacetime history. We're talking well above $37 trillion and climbing, with no credible path to stabilization on the horizon. Servicing that mountain of debt is now costing hundreds of billions of dollars a year in interest payments alone. From Tokyo's perspective, that is not just a number on a spreadsheet. It raises the question, how safe is it to keep holding so much of another country's IOUs when that country seems unable to slow its borrowing? Second, Donald Trump's return to the White House has been accompanied by a fresh wave of aggressive tariffs. In early 2025, the administration announced broad new duties that shook global markets and even hit longtime allies like Japan. It was a reminder that, in Washington's eyes, nobody is too friendly to be targeted if leverage is needed. Tariffs that strike at core industries like autos send a blunt signal. Alliance politics and economic pressure are now fully mixed tools. That makes Japan's financial exposure to the U.S. feel a lot less comfortable. Third, we have the weaponization of finance. When the U.S. and its partners froze parts of Russia's reserves after the eruption of the 2022 war with Ukraine, every capital holding large dollar reserves had to quietly ask itself a simple question. If they could do that to Russia, could that ever be done to us? Put these three forces together, and you get something like a flashing red light inside Japan's Ministry of Finance. The risk is no longer theoretical, it's strategic. The political face of this shift is Japan's new Prime Minister, Sanae Takaichi. She is the first woman to hold the office and leads a right-leaning coalition with a strong focus on security and national resilience. Her rise to power has come with a sharper, more hard-edged view of Japan's dependence on the United States. According to multiple reports, Takaichi has delivered a clear message behind closed doors. Japan's financial safety cannot be outsourced to Washington. Long-standing habits like automatically treating U.S. Treasuries as untouchable, safe assets are being re-examined through the lens of national security instead of tradition. In her circle, one phrase keeps coming up: unacceptable dependence. The idea is simple. If something can be used as leverage against you, it should not form the core of your national reserves, no matter how familiar or convenient it has been in the past. This new doctrine shows up in how Japanese officials now talk about reserves. Instead of praising dollar assets as the unquestioned foundation of stability, they emphasize the need for diversification into gold, other major currencies like the euro and pound, and even carefully managed exposure to the Chinese yuan. Under earlier governments, treasuries were treated as the bedrock. Under Takaichi, they are being downgraded to just one asset among many, and one that carries political risk. The market first felt this shift in a very concrete way in early 2025. Japan's Ministry of Finance released data showing an unusually sharp spike in the sale of foreign bonds, with more than $20 billion offloaded in a single month. That kind of volume is not normal portfolio tinkering. It's the kind of move that usually reflects a deliberate political or strategic decision. At first, some analysts assumed it was just a short-term reaction to volatility. But as more details emerged, it became clear that the main target of these sales was U.S. government debt. Japan was not just reshuffling, it was signaling. International banks started using a new phrase, the Japan unwind. The term refers to Japan slowly, methodically stepping back from its long-standing role as a passive, predictable holder of U.S. Treasuries. This doesn't mean Tokyo has dumped all its American bonds. Far from it. Japan still holds a huge amount of U.S. debt and remains one of Washington's most important creditors. But the behavior has changed. In the past, Japan would almost automatically roll maturing treasuries into new ones, treating U.S. debt as a safe parking lot. Now it is willing to sell in size when Washington's actions threaten Japanese interests. Think of it this way. For 30 years, Japan was the friend who always paid the bill without checking the price. Now that same friend is looking at the receipt, asking questions, and sometimes walking away. Even modest reductions in holdings, repeated over time and paired with a new mindset, send a powerful signal. Treasuries are no longer sacred. Behind the scenes, officials and major funds in Tokyo are said to be drawing their own red lines. These might include thresholds for U.S. debt levels, the escalation of tariffs, or the risk of asset freezes and sanctions. Crossing those lines could trigger more aggressive selling or a faster push into alternative assets. This brings us to the question, where is the money going instead? One major destination is gold. Central banks around the world have been increasing their gold reserves as a way to hold value outside any single country's legal and sanctions system. Japan has joined this trend, treating gold as insurance against unpredictable political decisions in Washington or elsewhere. Another destination is Europe. Japanese institutions have been building larger positions in European government bonds and high-grade private debt. Spreading exposure across multiple legal and political systems is viewed as a way to reduce the risk that any one capital can hold Japan's savings hostage. Corporate Japan is also quietly shifting its currency mix. Large companies and investment funds are gradually swapping part of their dollar holdings for euros, Swiss francs, and other safe currencies. The goal is not to abandon the dollar, but to make sure no single currency dominates the balance sheet. The common fear behind all these moves is straightforward. If the dollar system is now openly used as a tool of pressure, then no country can afford to assume its assets are untouchable simply because it is an ally. Japan's behavior is part of a wider global mood. Major emerging economies are experimenting with trading in their own currencies instead of defaulting to the dollar, especially in deals with China and Russia. The BRICS group is building and expanding its own payment channels, aiming to settle more trade outside the traditional dollar-centered system. At the same time, central banks worldwide have been diversifying their reserves. The dollar is still the dominant reserve currency by a long distance, but its share has been slowly drifting down over the past 2 decades as more countries add gold and a wider mix of currencies to their portfolios. What Japan is doing, then, is not isolated. It is a high-profile example of a broader instinct: diversify, hedge, and keep as many options open as possible, especially when geopolitics is becoming more confrontational. All of this is happening at a very awkward moment for the United States. The U.S. is running large budget deficits year after year, even in peacetime, and even with a strong economy on paper. Interest rates are much higher than they were a few years ago, which means rolling over existing debt has become far more expensive. The cost of servicing the national debt is racing toward $1 trillion per year, putting pressure on other parts of the budget. When you combine huge deficits, higher interest costs, and a slower growth outlook with weakening foreign appetite for treasuries, you get a much more fragile debt ecosystem. For decades, one assumption underpinned U.S. borrowing: there would always be foreign buyers willing to absorb whatever Washington issued. Japan, China, and oil-exporting countries formed the backbone of that foreign demand. They were seen as reliable, almost automatic customers of U.S. debt. But China has been gradually reducing its holdings for years. Now Japan, America's closest ally in Asia, is changing its behavior too. One moves quietly, the other sends more visible signals. Together, they undermine that old assumption. A useful historical analogy is the story of the British pound. A century ago, sterling dominated world reserves. Over time, as Britain's debt rose and its global role shrank, countries diversified away from the pound, little by little, decade by decade. Sterling did not collapse overnight, it faded. The concern in some circles is that if the U.S. continues to weaponize financial infrastructure and runs up debt with no clear plan, the dollar could slowly follow a similar path over the very long term. We are nowhere near that point today. The dollar remains the central currency of trade, finance, and reserves. But the direction of travel matters. Even small shifts from big players accumulate over time. So how far could Japan go? Tokyo does not need to sell everything to change the game. Even a gradual reduction, repeated steadily over several years, can reshape the balance of buyers and sellers in the Treasury market. If other large holders decide to follow the same logic, reduce exposure a bit here, diversify a bit there, the U.S. will have to lean more heavily on domestic investors or raise yields to attract fresh demand. That means higher borrowing costs for the U.S. government. Higher government borrowing costs tend to ripple outward, affecting mortgage rates, corporate debt, and the overall cost of capital in the economy. It also means less room for extraordinary fiscal stimulus in the next crisis. From Tokyo's perspective, this is not about punishing America. Japanese officials tend to frame it as self-defense. If tariffs, asset freezes, and currency pressure are all now normal tools of U.S. policy, then relying too heavily on U.S. assets is a strategic vulnerability. Japan, in other words, is acting like a country that has learned from watching what happened to others. So let's zoom out. Japan used to be the shock absorber of the U.S. debt market, quietly smoothing over America's borrowing needs in the background. Today, it is behaving more like a cautious risk manager, and the rest of the world is slowly starting to think the same way. Don't panic, don't rush, but gradually reduce dependence on any single power that can change the rules overnight. None of this implies that the dollar collapses tomorrow or that treasuries suddenly become junk. But it does mean the old certainty that foreign buyers will always be there no matter what, no longer feels guaranteed. That is the real story behind the headlines about Japan selling U.S. debt. So what do you think? Is Japan simply doing what any rational country should do in this environment? Or are we watching the first visible phase of a much larger shift away from the dollar that Washington is underestimating? Let us know your thoughts in the comments. And if you found this breakdown helpful, don't forget to like the video, subscribe to the channel, and turn on notifications so you don't miss the next deep dive into the global financial system. Thanks for watching, and we'll see you in the next one.